Good afternoon, everybody. Thanks for being here with us today. We're going to go ahead and get started in just a moment. All right, we're going to go ahead and get started. We have Andrew Smith and Katie Jamil joining us today discussing 401k guide in a COVID-19 world.
Thank you, Ashley. Good afternoon, everyone, and thank you for joining our webinar this afternoon. As Ashley mentioned, a 401k guide in the COVID world. My name is Andrew Smith. I'm one of the partners here at Cornerstone. I'm also a certified financial planner and wealth advisor here with the firm. And I just want to take a moment to welcome our clients. For those of you who have tuned in, we appreciate you joining us this afternoon. And for those of you who are not clients of the firm, we hope you find this information valuable. With me today, I have Katie Jamil. Katie is a certified financial planner, and she is the director of the retirement plan division, Cornerstone Retire, the division of Cornerstone Wealth. Katie?
Hi, everyone. As Andy mentioned, my name is Katie Jamil, better known as 401 Katie. I specialize in all things retirement plans, so you don't have to. Today, we will be reviewing reasons why employers offer a plan design provisions, fiduciary responsibilities, and the impact COVID-19 has had on retirement plans from both an employer and employee standpoint.
Perfect. Thank you, Katie. Like Katie said, we are going to talk about 401k plans from both an employer perspective, but also the employee or the participant. This slide mainly deals with employers and why they offer 401k plans. So, if you're managing a large 401k plan or just starting a company and implementing a new plan, there's really three major reasons that an employer implements a 401k plan. So the first one is really to attract employees. The second one is to retain those employees. And then the third one is to reward those employees. So let's talk about attracting employees. So obviously you run a business, you want to attract top talent. Well, how do you do that? Well, you offer benefits. I would say behind health insurance, being an employer, that's probably the number one question I've been asked over the last 20 years is what do you offer in terms of retirement plan? So believe it or not, employees are obviously looking at various companies and, people will try to hire your folks away. So you want to offer a very attractive plan and obviously you want to retain those employees. And so the second option is retention. And so retention comes in a couple of different formats. Obviously, offering a good match is a good way to retain your employees. If your match has a vesting schedule, that's another way to retain them. So sometimes you have a cliff or a graduated vesting schedule, and you're going to be able to retain those employees if they don't want to lose that money if they leave the company. And then lastly, there's ways of rewarding employees. And so if you think about running a company, all of your employees are there to help you, make your company successful. You want to try and reward them. Maybe let's just say you have a really profitable year and you want to reward your employees with some of the profit. There's ways of adding a profit sharing component to the 401k. And with this, you can also add a vesting schedule. So another way to retain those employees. And I think from an employee perspective and a participant perspective, obviously the number one goal for us working with them is to help them achieve their retirement goals. If you think about retirement, it's kind of scary because you look at retirement and you try to determine where your income is going to come from. I would say the average adult who has worked their entire life and paid into Social Security is going to get between 35 to 40% of their previous earnings in the form of Social Security benefits. So it's really, really important that we help the participants plan for a good retirement.
Yeah, and as an employee at Cornerstone, I really appreciate my 401k benefit and the generosity of my employer. It's something I think about as I see my account balance grow over time. It's just really great that I have a company that helps me work on achieving my retirement goals. So now that we've reviewed why employers offer retirement plans, let's talk about how they function. So evaluating your 401k plan service providers, there's a whole team behind a 401k plan. There's just not the employer that's in control of this 401k plan. We want employers to focus on running the company rather than running a 401k plan. And there's a whole team approach behind this. So as the company, you're the plan sponsor. You do have fiduciary responsibilities. To help you with those responsibilities and really be your quarterback, you hire a retirement plan consultant or a financial advisor. That's what Cornerstone Wealth Group does for your plan. We ultimately are co-fiduciary, acting in the best interest of your plan participants, hoping to achieve an optimal 401k solution for you. There's also the custodian and record keeping company. So those are the Vanguards, the Fidelities, the Voyas that you might be familiar with. They're ultimately the custodian of the employee deferrals, and they also record keep which deferrals or assets are employees, employers, and keeps track of that for you. Another provider is the administrator. So this could be standalone third-party administrator or be bundled with the record keeper. The administrator is ultimately responsible for the compliance of your plan. So they help with plan design, establishing plan documents, and just really making sure your plan's in compliance. And lastly, you have the plan auditor. Now this doesn't apply to all 401k plans, but it does apply to those with 120 or more eligible employees. Your plan auditor will review financials, and it's really just an internal audit. So it's not a DOL audit, but it's an internal audit that's required each year if you have a specific employee count.
Great. Good job, Katie. So obviously there are many, many parties that can be involved. I think with us, we like to serve as the quarterback. And for those of you who own businesses, we really help your plan run smoothly. If you are working with someone else and you wanted us to help you explore options, we're going to talk about that in the coming slides. If you're an employee or participant in a plan, obviously a retirement plan consultant can be a very important part of that journey because they can help you make great decisions in terms of what you contribute, how much you contribute, how often you increase that, and then of course how you manage the plan on an ongoing basis. So from a design perspective, obviously employees, potential employees, participants are attracted to contributions from the employer. So before we go into this, I would like to first explain that ERISA, which is the Employment Retirement Income Security Act, basically governs how employers can contribute to plans. And of course, there are discrimination tests that we have to follow. And so the one thing you need to understand is there are highly compensated employees and there are non-highly compensated employees within ERISA. That threshold is $130,000. So for those of the employees making under 130, they're considered non-highly compensated. And from a contribution standpoint and from a matching perspective, we have to keep this in mind. Typically, if you have just highly compensated employees contributing, oftentimes you'll have some of those employees get refunds. And so the typical test allows the highly compensated employees to defer approximately 2% more than the non-highly compensated employees. So keep that in mind as we talk about these 4 different matches. So for companies that don't want to match, perhaps they're a new company, perhaps maybe they put their emphasis on cash earnings and not necessarily the 401k plan. Well, they may not choose to have a match for some reason, right? So there, obviously from a competition perspective, there could be other employers that try to take their employees because they don't offer a match, but that's their choice. So in a non-matching environment, you still obviously are going to have a 401k plan in which employees can defer into. Potentially the highly compensated employees are going to be limited on what they can contribute because non-highly compensated employees may or may not be contributing to a large level or high percentage because they're not receiving a match. So that's not something we see on a regular basis, but definitely at times like COVID, where people have cut their matches out completely, we will run into that, so testing comes into play. The discretionary match is a match that we oftentimes see that can be stopped at any point. So obviously here, if you provide a match, you can also add a vesting schedule. There are a few different vesting schedule options. There's also several different matching options. I think some of the most common matches that we see are 3% on each dollar you contribute. So 100% up to 3, for example, or they might be 50% up to 6%. And sometimes they take it on up to 8%. So it looks like you're getting 8, but you're only really getting 50% of 8, so you're getting 4. So that's going to help increase the contribution of the non-highly compensated employees, allowing for highly compensated employees to put in a little bit more money. So if you don't like the testing, you don't want to have to deal with refunds, then there's a provision called Safe Harbor. And Safe Harbor comes in 2 different flavors. There's contributory and then there's non-contributory. So contributory is usually what we see in the industry. And this is where basically non-highly compensated employees want to be able to max out. And one of the matches that are allowed is basically 50%, dollar for dollar on 3% and then 50% on the next 2. So essentially if an employee puts in 5, they're going to get 4%. This will allow the the highly compensated employee to max out without having to worry about testing. Now, one difference here is there is no vesting schedule. So, obviously the money's going to be the employees when they make the contribution and get the match. So the last part, let's assume you had a really profitable year and on top of a match, Safe Harbor or discretionary, you wanted to add a profit sharing calculation. There's a way of adding an additional contribution on top of those contributions that will meet a certain limit. And basically it can be distributed amongst the employees. And there are ways of actually contributing to certain groups of employees, which we won't get into today in this presentation. So that helps you understand some of the contributions that employers can make.
As Andy mentioned, with COVID-19, many of my clients have reduced their match or suspended their match. Hopefully, as an employer, you haven't had to do so. As an employee, you're still taking advantage of the benefit. But with or without employer contributions, offering a retirement plan for your employees to defer and save for retirement is still beneficial. Very few people would not make or would not contribute money to a separate savings account specifically for retirement. So having it just ease of use through payroll and out of sight, out of mind, deferring it into the plan is very beneficial for employees. After deciding on what works best as from a contribution standpoint, the next step is designing your plan. There's many provisions that you can customize, and we're going to be reviewing a few popular ones today. So customizing your plan document, there's so many provisions that you can select from. It's really, each plan is so different. There's not a typical plan that everybody follows, so you can really customize it to make it your own benefit. Now, 6 provisions that we want to discuss today before we talk more about the CARES Act are auto enrollment, auto escalate, Roth 401k, loans and distributions, vesting schedules, as well as the determination period. So auto enrollment is a very popular provision. It really helps with participation rate. It ultimately gives employees the a chance to opt out rather than having to opt into the plan. Many people don't take the initiative to opt out, so that's why the participation rates usually increase with auto enrollment. You have auto escalate as well. So with auto escalate, that ultimately means that you can set a schedule where the deferral for the employee increases each year. So for example, if you have auto enrollment at 3% and you want auto escalate to go 1% each year until the employee reaches 10%, you can do so. Why I said 10% is generally the rule of thumb. You should be saving anywhere from 10 to 15% in your retirement account each year. So 10 to 15% is the magic number, and your employer contribution does go towards that number. Both auto enrollment and auto escalate do have a $500 tax credit. This is new to 2020. So $500 tax credit each for either auto enrollment, auto escalate, and implementing that into your plan. The Roth 401k, it's a very powerful provision. I think that all plans should have this option. Many people are familiar with the traditional pre-tax where you're saving money today but having to pay taxes later. Well, Roth is the opposite. Roth is you pay taxes today, and then when you take a qualified distribution, meaning you've reached age 59 and a half, and your account's been open 5 years, then you don't have to pay taxes on the distribution. You may be thinking, why would I have to pay taxes? I've already paid taxes on my portion. Well, it's the market earnings throughout the years that are so powerful and helps your account grow. As long as it's qualified, you don't have to pay taxes on the earnings. Loans and distributions, that's a great provision for 401k plans. Many employers select a 401k plan because of the option to borrow against your account or take money from your account. There's 59 and a half in-service distributions. So if you're currently employed, working for a company that has a 401k plan, if you have reached age 59 and a half, your plan may allow for you to take your money out and either use it, roll it over into an IRA, just many different options. So keep that in mind. Vesting schedules, that's where you can add a vesting schedule to employer contributions. Employers usually like to retain, as Andy mentioned, employees. So this vesting schedule helps, and each year you get credited a certain amount, up to 6 years being the maximum. So once you're with a company for a maximum of 6 years, that money is portable. And lastly, the termination period, that is whether or not the employer makes the contributions, the employer money, on a payroll basis or plan year basis. And I know, Andy, you have a great example of what happened in the past that you'd like to share with us.
Yeah, actually a couple different examples. I would say from a determination period, sometimes you learn from the school of hard knocks. This was one I definitely learned, kind of the hard way, working with a client, and he was retiring from a major corporation here in Charlotte. And towards the end of his career, he was able to maximize his contribution. So he was able to put in, let's just call it $26,000 into his 401k plan. I mean, that's a great way to pre-tax, save some money for retirement, but he was really looking to save the taxes, obviously, and maximize that contribution. Well, he front-loaded it within the first 6 months. So we actually started looking into his match, and he was matched on a payroll period, not throughout the calendar year. So he literally missed out on some match. And this was before I actually met him. So we looked into this, and I had learned some about this and known a couple people that it happened to. So if you are currently working for a company and you don't understand the determination period, you should call your 401k administrator, service provider, and contact them and ask them, am I matched per paycheck or am I matched per year? If there's a true up, then obviously the match is made up if you missed out on part of the match. If there's not a true up, then you're not, and you simply forego the match. So not something you want to learn about the hard way, obviously. The second thing I would like to just touch on, I'm a big proponent of 401k, the Roth 401k especially. A lot of people don't understand what's going on with our government Obviously, there's been stimulus packages and PPP and all the stuff that's happened with the coronavirus. Our debt continues to grow. And I would tell you that having some money positioned in the future that's completely tax-free is going to be very beneficial in your retirement years. So no matter if you're rank and file employee or you're an executive, Katie, I'm not sure if you mentioned the 401k does not have an income limit like a lot of people think the Roth IRA does. It has no income limit, so you can contribute to this account. And also, like personally, what I do is I actually contribute 50% of my contribution to the pre-tax 401k, and then another 50% to the Roth 401k. And that way I've done both, right? And in the future, I'll have both pre-tax dollars and I'll have tax-free dollars. So just worth mentioning.
Yes, and for Roth and pre-tax, the limit for 2020 is $19,500. If you turn 50 this year or are older, you can do a catch-up contribution of $6,500, and both your pre-tax and Roth contributions will cannot surpass those limits.
And that catch-up, just by the way, before you go to the next slide, if you turned 50 in November or December even, the last day of December, you turn 50 that year. So a lot of people don't know that, but that extra catch-up contribution can start the year you turn 50, and you need to put it in throughout, the year. So finding this out on December 31st won't do you much good. Okay, so the CARES Act. So in the title of our presentation, we talk about COVID, and COVID has had a huge impact on the world. Of course, the economy, the stock market, just the economy here locally. It's impacted people's decision making, and so obviously has an impact on people's largest asset in some cases is their 401k plan. And so we're going to talk about some provisions that came out of the CARES Act, which, by the way, stands for Coronavirus Aid, Relief, Economic Security Act. And so why was this act passed? So on May 27th of 2020, Congress passed this, obviously, to provide aid and relief to 401k participants. And so we're going to talk about optional provisions, and we're going to talk about mandatory provision that's inside of the 401k plan. And so for these first three that we're going to talk about, you have to qualify in order to do either one of these or two of these. I think you can do it at the same time. So first off, you have to qualify, which means that you have COVID, right? You've been diagnosed with COVID, or your spouse has been diagnosed with COVID, or due to COVID, you have lost income because you've been furloughed or terminated from your position. So keep that in mind. Also optional, you have to basically have your employer adopt these provisions. If they don't adopt these provisions, then you can't do this within your plan. So assume you are an employee, you have a loan on your 401k plan, perhaps you're furloughed, perhaps your spouse has lost their job and you just need the additional income, but you have a monthly payment. You can suspend the loan for up to 1 year. So basically they'll stop the loan payment. At the end of 1 year, they will re-amortize the loan and it'll basically continue in 2021. So that is something that we've actually implemented for one of our plans that we managed, and an employee decided that they needed to do that. So we adopted this provision. Increased loan limits is another one. So typically, for those of you on the call, you may or may not know this, but you can have loans up to $50,000 or 50% of your balance, whichever is lower. So if you had $500,000 balance, then you can only take out $50,000. If you had a $75,000 balance, then basically you're going to be able to take out 50%, which in that case would be $37,500. So if you have any questions about that, you certainly let us know. But now until September 23rd of this year, which is an odd date, but you can increase that up to $100,000. Katie reminded me that obviously $100,000 loan limit over a 5-year term, which is the maximum term, that's a pretty hefty payment. So just keep that in mind. But a lot of people are considering, and again, you have to qualify, is to take a coronavirus related distribution. So we love acronyms in our business, and it stands for CRD. And so if you take a CRD, they're going to waive the 20% mandatory withholding. If you're not 59.5, you're not going to have a 10% penalty, and you can take a distribution up to $100,000. And what's nice about this is there is no loan payment. You have to pay this back into the 401k plan for it not to be taxable, basically within a 3-year period. So you could wait all the way to the end of the 3rd year and put this back in, but just be certain that you qualify. I'm sure that the government will be looking at this very closely. So this last one is a mandatory provision. So for those of you that know what a required minimum distribution is, if you're still saving, you may or may not know what this is. So when you turn 70 and a half, and this is if you were born before June 30th of 1949, recently with the Secures Act, that changed to 72. So for anyone born after that date, it's now 72. If you are working for a company and you are not the owner, then you are not required to take RMDs anyway. So this wouldn't really apply to you. So you're probably wondering why it matters. Well, if you're terminated or you have retired and your money's still in the 401k plan, you're required to take a distribution. In 2020, they're waiving distributions. Those will resume back in 2021. So you'll want to keep an eye on that. For those of you that have IRAs, same thing applies, those same ages, same dates. You have to take RMDs on an annual basis, and that's waived for IRAs as well for this year only. So that will resume back in 2021.
Great, and with these provisions being relatively new, many service providers have yet to streamline the process. Plan participants, as well as employers of the plan sponsors, are unaware whether their plan has these provisions. So some allow for opt-in, others allow for opt-out. If you're unaware, please find out from your employer. If you're an employer and want to discuss more about your, options, you can reach out to us. But as an employer, you need to understand the provisions within your plan document. It is a fiduciary responsibility, and we'll be talking more about fiduciary responsibilities here. Monitoring expenses is, of course, a big responsibility, making sure that the fees are necessary for the operation and establishment of the plan. So I always recommend benchmarking your total cost of the plan at least every 3 years. I'm seeing it more frequently on an annual review, revisiting the plan fees each year, actually, to just make sure that they are low cost. And then, of course, taking care of your lineup. So monitoring it on a quarterly basis, having the reports to document that you are paying attention to the lineup, hiring a financial advisor to act as a co-fiduciary in a 321 or 338 capacity. 321 meaning assisting you with the investment lineup, whereas 338 is full discretion. Developing an investment policy statement and having that on file is important. So the DOL doesn't, require an investment policy statement, but it's always good to have one if you were to have an external audit. Having an investment committee, making sure that your investment lineup is based upon set criteria and is followed along in that investment policy statement. And as I mentioned, documentation, that is always important for the chance that you are audited, you have a whole process, you are having a benchmark of fees, you are having a diversified lineup. And Annie's going to talk more about the different options that you can have in your plan.
Yeah, you mentioned investment policy statement. This is something that you're not required to have, but you really should. And honestly, when I read about this, it's kind of like the business plan for your 401k investment lineup. So let's talk about how do you construct a lineup of funds. So there's two different things you want to keep in mind here. And we can go into a lot of detail, but we'll try to keep this high level. There are different investment options, and then of course being properly diversified. And so the first two, I would say, most people are very familiar with professionally managed mutual funds. Some people are becoming more exposed to exchange traded funds, index funds, and then as of late, target date funds have become very popular, especially within 401k plans. So a professionally managed fund, the best way to describe that is if you have the S&P 500, and there's over 500 companies in the S&P 500, just slightly over that. Well, a professionally managed account may be buying large caps that are similar to the S&P 500, but maybe they focus just in, maybe 75 to 100 different holdings. And what they're trying to do is find the best ideas within the S&P 500, and for that, there's going to be a management fee. And so typically that's going to be a little higher than the second one, which is a passively managed fund. Passively managed funds are going to basically match an index. So in my example, an S&P 500 fund would have the exact holdings within the S&P 500. It's a difficult benchmark to beat, but obviously large caps don't outperform every asset class every year. So you don't want to just put it in one index fund. So there's going to be different types of index funds, different types of professionally managed funds, which we'll talk about in a moment. And then last but not least, target date funds. A lot of people don't want to manage their portfolio, or they don't have the expertise to do so. So target date funds were created to basically match up with your retirement goals and perhaps maybe the year in which you want to retire. So for example, a very popular target date fund group is the American Funds or Vanguard. And so they may have a 2050 target date fund. And that fund is going to be managed for someone who wants to retire in approximately 30 years. So 2050 minus 2020 is 30 years. So typically that's going to have more equity exposure, so more stocks, less fixed income, maybe a little alternative investments. But as that person grows older and gets closer to retirement, these target date funds are going to shift over time and become more conservative. So these are kind of set it and forget it. You don't have to manage it yourself. A professional manager is doing so. So very popular for folks that don't want to have to worry, still have a little bit higher expenses. So you want to keep an eye on those. We help with that process. And then the proper diversification. Oftentimes I'll see 401k plans that have way, way, way too many options. Maybe 30, 40 options, just not necessary. You really want to cover about 4 or 5 different areas. One, domestic stock. And as long as I think you have large cap and small cap covered, maybe you have a mid cap, you have most of the stock covered, especially if you're in a professionally managed fund or an index fund. With international stock, you're obviously adding exposure to companies that are domiciled outside of the US. You may have a global fund, and a global fund is going to buy stocks that do business around the world, obviously. And then, of course, fixed income. So I always tell people, bond funds, there's just as many flavors of bonds as there are stocks, but oftentimes you see 1 or 2 bond funds. And so there are various types, could be corporates, agencies, mortgage-backed securities, corporate high yield, so on and so forth. And so you want to make sure you have plenty of exposure to fixed income because, prior to the bull market, you actually had a bond rally. And so when interest rates, start heading down, bond prices are going to do really well, which we can talk with you and the investment committee about. And then, of course, real estate. So real estate's been a really hot area. Maybe Class A office space won't be a hot area in the coming future. So we want to make sure we understand what type of real estate is in the portfolio. All right.
And so this year I've been doing a lot of transitions for my clients, meaning they're transitioning to a different custodian record keeper in order to keep costs low, or maybe I transitioned in order to have more investment options or a certain suite of investment options, such as the target date funds. As Andy mentioned, American Funds is one of the leading portfolios. And what we do as a retirement plan consultant, we also offer education. So making sure that your employees are aware of what investments are in the lineup and how they can select from these investments are really important. Again, we're going to revisit fiduciary responsibilities, but education is a big component of 401k plans. Why have a 401k plan if your employees are unaware of the benefit, what they can do, that they can max out, how much they should be saving, and really develop an investment allocation that will help them reach their goals. So educating employees is definitely a fiduciary responsibility that we don't take lightly. We provide in-person, on-site meetings, one-on-one meetings even with employees. So, we can do group, one-on-one, and also with COVID-19, there's been many, many webinars. So whatever is best for your company, or if you're an employee that hasn't had education on your retirement plan, you should ask your company if that's possible. Also making sure that employees are aware that they can join the plan. Big responsibility. You don't want to miss entry dates for those employees, making sure that they are aware that they can defer into the plan. Timely deposits of participant contributions. This is a big one. Employers are not allowed to hold on to employee deferrals for more than 7 business days or as reasonable possible. And then timely notifications of changes to plan. So these notifications must be sent to plan participants, making them aware of perhaps investment changes, fee changes, maybe your match has changed, especially this year. So just keeping employees informed is a responsibility that you as the employer should be aware of, and you as an employee should notate.
Thank you, Katie. That's great. You make a really good point. There are corporations that are so large that they don't feel like maybe someone's coming in and educating the employees. And so if someone's listening in and they wanted us to come in, even do a webinar for that matter, and discuss various topics, investment allocations, how much should I be saving, how does the Roth work? There are some people may have heard of the mega Roth. Some large plans have an after-tax contribution where you contribute above and beyond what you're contributing in your pre-tax or your Roth 401k. And that can actually be rolled out into a Roth IRA. And every plan's different, but they call that a mega Roth strategy. And I probably have about 6 clients doing that currently. And it is just a fantastic way of growing the Roth balance in a very short period of time. So lots of things that we can do even if we don't handle the 401k. So for those of you in an HR capacity or would like for us to come in and speak to your company, then, of course, we'll be your advocate.
Great. And, as business owners, HR managers, CFOs, it's really not your job to know everything about a 401k plan. You just need to hire the right team and it can make a huge difference.
That's funny you say that, Katie. We're taking over a plan currently, and the lady said, yeah, they all ask me what they should put their money in, and she's running HR. So that is definitely not a fiduciary responsibility that you need to take lightly. Pass that off to a professional. We're all certified financial planners here. I believe we have 12 or 13 CFPs. We have a CFA on staff. So let us handle that conversation for you. So I wanted to just take just a moment and thank everyone for joining us. I know you're all busy. We appreciate your time. Hopefully we answered your questions. Katie, do we have some questions that have come in?
I do not see any at this time. Please feel free. You can type in your Q&A into the box if you have any questions. If you don't have any questions today, you can always contact us at a later date. Just give it a few more minutes. Okay.
Can you put our contact information up on the next slide?
Sure.
Yeah.
Yep. So you can reach out to us by phone, 704-987-3410, or by email. My email address is kjamil@cwgretire.com. Again, if you don't have a question today, please reach out to us. We can assist with employer questions as well as just plan participant questions. We may not have the plan provisions of your plan that you participate in, but we can ultimately guide you on who to turn to or just, specific provisions that they may have.
And also just wanted to remind everyone, we do this on a bi-weekly basis. So we cover various topics. We've talked so far about estate planning, tax planning, a number of topics. And then also on a weekly basis, Jeff Carbone and Cliff Hodge, our CFA and CIO, Chief Investment Officer, do a weekly market update. So for those of you that want to learn more about what's going on in the economy and the market, we're trying to stay active since we're all either working from our offices or home and not seeing everyone face to face, but we'd love to have you join us. And since we don't have any questions, we'll wrap up. But thank you again for your time. We look forward to speaking with you in the near future. Have a great evening.
Have a good one.
Bye-bye.